The final rule has been issued on short-term health plans. Now, these are the short insurance plans meant to cover gaps in coverage. It used to be just 3 months in duration. The federal government has been pushing for these to be extended to a much longer duration. But there are problems with short-term health plans, and we'll talk about that in a second. But let's refresh our memory on the timeline of how we got here. This all started with an executive order back in October of 2017. It was a Trump executive order on short-term health plans and association health plans, the two insurance types that have been called junk insurance by many advocates and health policy experts out there, because they offer very little coverage and don't have to follow the consumer protections provisions of the Affordable Care Act. Fast forward to February 2018, we got a proposed rule on short-term insurance. A public comment period closed in April. August 1st, the final rule was issued. Now, it becomes effective 60 days after publication in the Federal Register, which is expected any day. So that puts us at about October 1st for when short-term insurance plans can be offered for the first time under the new arrangement. So short-term insurance plans are a thing right now. They have been for a long time. But under the current rule, for the next 2 months at least, insurance plans that are considered short-term health plans must have a term that is under 3 months in duration and cannot be renewed. They are kind of the stopgap coverage, knowing that it's not comprehensive health coverage, but it's something. Some people find them attractive because they're a little bit cheaper than comprehensive coverage, but the surprise usually comes when you end up in the emergency room or start going for care that's not part of the covered services, and then individuals end up getting a bill for those additional services. It does not have to follow essential health benefits. It doesn't have to be comprehensive. It doesn't have to cover maternity or newborn care or essential health benefits at all. So these can be really skimpy plans, and that's the way they are right now. The new rule, as the final rule, allows for the sale and renewal of short-term limited plans, but not limited in duration to up to 3 months. Now they're extended to up to 12 months with the possibility of renewal for an additional up to 2 years. So you could have a short-term insurance plan that is actually 36 months, just under 36 months in duration. All of this is up now to the insurance commissioners of each state to allow the sale and to allow the renewal of short-term health plans in their state. And again, like we said, the provisions will stay the same from the old short-term health plans to the new short-term health plans, that people with pre-existing conditions can be denied and plans don't have to cover essential health benefits like mental health, maternity, newborn, etc., prescription, etc. Now, of course, there are risks, and this is why there's so much conversation and why these continue to be called junk plans. The coverage is skimpy. It's not offering consumer protections. These plans have high deductibles usually and very low medical loss ratios, which means the money that you do pay into these plans isn't necessarily spent on your claims. Some health plans were actually, short-term plans were actually reporting in the 30% medical loss ratio. They're only spending about 30 to 34% of what you pay in on your claims. The top seller of short-term plans last year was only hitting a 43.7% medical loss ratio. Deductibles on some of those plans were upwards of $10,000. So you can see why consumers might find this risky, but might find it appealing because they see that little bit lower premium and think they're getting comprehensive health coverage when they're not. Like we said, this does not satisfy the individual mandate. It divides the market. The biggest fear is healthier enrollees in the marketplace might opt out of the health insurance marketplace and instead go for one of these skimpier plans, only to be surprised later, thereby making the marketplace risk pool sicker as well. Insurers are actually jittery over this decision, and there's been a lot of conversation of that in the media. And there's also the reminder that a lot of these plans have a history of leaving consumers with large medical bills, large medical debt. And it's usually coming as a surprise because they thought their coverage offered a lot more than it did. Now there's the bigger conversation about what this actually is doing to the Affordable Care Act. In addition to making a sicker risk pool, it's actually chipping away at those consumer protections that were so hard fought for in the Affordable Care Act. Less stable, makes for a less competitive individual market, and as a result, you might just see premiums across the board going up. You can read this final rule for yourself. There's also a report that comes from the National Association of Insurance Commissioners that talks a little bit more about those medical loss ratios, and you can look those up for yourself in that comprehensive report. And we have links to these in the description below. You can share your healthcare story. What do you think about short-term health plans and association health plans? You can send us an email, and you can do all of that at healthwatchwisconsin.org.